Stock markets continue to set record highs this year, and that has some investors getting a little nervous about those lofty valuations. Som Seif is president and CEO of Purpose Investments. He's here with his insights. And our first question is, when is it time to reduce the equity portion of your portfolio after a big run-up in the stock market? It's not an easy question, is it? And can you tell me when the top is as well while you're at it?
Well, you know, I think the first thing I always tell people is that overthinking or over trading your portfolio, too much trading actually leads to many mistakes. And so we always believe that if you overtrade, you're going to make more mistakes and more outcomes that we'll be unhappy with. But I think there is a really important question here, which is, when do you rebalance? Mm-hmm. When do you, if one part of your portfolio, let's say your equity part of your portfolio and a diversified portfolio has increased quite dramatically, when do you rebalance? I think there's a couple things that are really important. First, whenever you build a portfolio, you should be diversified. You should have multiple assets, that give you good diversification. And then you should set a good discipline, and you should stick to that discipline, which is rebalance, once or twice a year. And that will always get you back into sort of your goal of risk weighting.
So you do it on a time basis,
yeah.
like rather than saying when certain markers in the market appear, that will be my signal to rebalance.
What we've found is it's very difficult to really time the markets and try to call it. I guess very few people are very good at that. In fact, we've proven that very few people are good at it. So the best thing that we found over time is to just set dates and be unemotional about those dates. So call it, let's say, twice a year. In June and December, you're going to rebalance your portfolio back to your target allocation, target weights. And that way, what you actually allow is equity markets have momentum behind them. It's what we're seeing today is this really great momentum behind it. And momentum, you want it to play itself out. So let them play itself out, rebalance, twice a year, carve it back, take some winning off the table, add to your losers. And over time, you're actually going to find that will be a wonderful experience for investors.
And for sort of retail investors, people out here are watching the show, when you do that rebalancing, how do you figure out what the ideal mix should be in your portfolio?
Well, this is a really important question around risk and what level of risk. And I think, in my opinion, I think investors have to think of this differently than they did over the last 30 years because, a large part of portfolios were in bonds.
Yes.
And I think, if we fast forward over the next 10, 20 years, bond investing is not going to be as easy as it was in the past. So we have to rethink the asset mix. But I think the first thing people always should look at is what's your risk, what's your sort of tolerance for risk. And with that, then you're going to look at what your allocation to different asset classes, including things like equities, alternative strategies, real estate, real assets, which we'll talk a little bit about on inflation,
yeah.
and then things like cash and fixed income. And I think every portfolio should have a fair amount of all of this in their portfolio altogether.
I want to talk more about bonds as well, but maybe we should set up inflation first of all, since it's obviously relevant. The other key question that we wanted to ask you was what effect will inflation have on investments and what adjustments should a person make to protect them? Well,
right now inflation is having very little impact on the markets as we're seeing inflation being somewhat sort of very light and in fact we're seeing
it was stronger in Canada though today, right? 2.4%.
2.4 versus 2. I mean, it's still within the sort of 2 to 4% range that we want to see, and we're not talking about 1980 inflation of 13-15% here.
Right.
So inflation is low, and long-term inflation should be in that 2 to 2.5-3% range, and that's actually a pretty decent inflation rate. But all portfolios do need to be thoughtful about inflation. I'm a big believer that every portfolio should have some portion of real assets, things that will give you real physical exposure to things like real estate, property, infrastructure, agriculture, areas like that, commodities, which I think are really powerful to help protect and protect inflation risks in the portfolio. But in general, I think inflation is something that everyone has to be aware of, and it's only, I think, going to get worse over the next 5 or 10 years.
Yeah, it's interesting because you mentioned that it's so difficult to invest in bonds. Traditionally, for retail investors, sovereign debt, right? Canada Savings Bond, that was kind of your safe thing. And it has been so difficult to tell how much value you can wring out of that, because normally when interest rates are falling, when yields are falling, the value of those holdings go up. Is there more value to be wrung out of that sector now?
I think we're kind of done on government bonds, unfortunately. And remember, bonds have two purposes in a portfolio. First is to help de-risk your equity side of your portfolio. Really powerful, and it'll always do that. but the second is to make you some return. And unfortunately, the return element's probably gone. I mean, when we see interest rates where they are today, and remember, when interest rates rise, bond prices fall. So when interest rates have come down, as they have, bond prices go up. So everyone's been rewarded with a wonderful experience of bonds. Government bonds have a direct interest rate experience. And so my honest opinion is government bonds are going to be an extremely difficult place. I don't like GICs in general, but if I was a very conservative, ultra-conservative investor, I would be in a GIC over a government bond just because that's a better long-term solution. But I still think that a lot of those things are just not going to give you anything but protection.
Yeah, and what you hear again and again from people is interest rates are so low, I don't know where to put my money. If you're right and inflation is only going to go up from here, gold as a hedge against inflation?
Gold,
what do you invest in then?
So, as I mentioned, so there's two things. Real assets. Real assets are very important. I do think that you can include high growth equities. So one of the challenges is that equities in general have different sensitivities. So interest sensitive equities like dividend paying stocks that aren't growing, like utilities and other things, generally will actually be negative places in a high inflation environment. But high growth stocks, companies that are able to keep up with economic growth and inflation, actually are really good. So
are those easy to find nowadays, given the run-ups that we've seen in the stock markets?
Well, look, what you want to look at is the fundamentals, is the businesses themselves growing. I'm not talking about the stocks, but the businesses. So if a company is growing its business consistently, that's a high growth stock, not the stock price itself. And I think there are lots of high growth stocks, because if there's inflation, that means the economy is doing better, and therefore it means that companies can grow in that environment.
All right, we'll leave it there, Som. Thank you.
Great to be here.